Now, before we get to the live questions, I wanted to cover this issue that came in via email this afternoon. Are covered calls and collars on the VIX or VIXY a reasonable trading strategy? Now, this question came from Anthony. His direct question was, is trading with VIX or VIXY a reasonable strategy for income with a covered call or a collar? First, what is VIX? Well, on power options, it's $VIX. Any index on power options is preceded by a $. So in power options, it's $SPX, $NDX, excuse me, and $RUT, and $VIX. The VIX is the CBOE Volatility Index, and this represents the market's expectations for the relative near-term prices or the volatility over the next 30 days in the market is essentially what it's looking at. It's based on sort of futures prices and other things, but kind of looking at a 30-day forward projection of the volatility expected in the market. VIX itself is an index, such as SPX, NDX, and RUT, the Russell 3000. Which means what? Which means we can't buy shares of the underlying security. We can't buy shares of VIX. We can't buy shares of SPX, which means it cannot be used as a standard covered call where we buy stock, sell an at, out of the money, or maybe in the money covered call, or as a standard collar position where we buy the security, sell maybe an at or slightly out of the money call 30 days out in time, and buy an out of the money put with the same expiration date for a standard collar position. We can't do that with these securities because we can't own the underlying. Now, other instruments such as VIXY, UVXY, and VXX are ETFs or ETNs that can be purchased and could potentially be used for a standard covered call approach or a standard collar approach. VIXY is the short-term futures ETF. It has a similar chart to the VIX, and we can purchase those shares. UVXY is an ultra. It means it's a 2 times short-term ETF representing the VIX. You see here it has a very, very similar chart to VIXY. This is a 6-month chart, by the way, for all of these securities. VXX is the iPath series S&P 500 VIX short-term futures, ETN, exchange-traded note. Very similar to an ETF, subtle differences, but shares can be purchased, so it could be used as a covered call or, of course, as a collar position. Now, a parity trade to a covered call, of course, would be the naked put. You could do a naked put on VIX. But look at the last 6 months charts for these particular positions. And what was the market doing during this time? Well, in the past 6 months, we were sort of moving up in price, having a little hiccup, going up to new highs, having a little hiccup, really in the last 3 months or so. But what is the general trend that we're looking at for these positions? Well, the general trend for the volatility as the market was melting up and hitting new highs is negative. It's not neutral to bullish, which we'd need for those other strategies. It is mostly bearish direction, which is important because if you expect the market to continue what it's been doing, the covered call and a collar are neutral to bullish positions. We want the underlying to be static or moving up in price, similar to what SPY has done over the past 6 months. Yes, there's some hiccups in there. Yes, there's some times when the volatility increased because SPY had a sudden decline in price. But the overall trend of the volatility, if the market continues the way it's been going, is going to be the same way. It's going to be going down, then have a slight hiccup up, as we saw yesterday on Thursday, July 8th, with a 1.2, 1.4% decline in the broad-based markets. The VIX sort of moved up from 16 to 19, but then it pulled back again today. The average trend is bearish if the market is going up. So 6 months side by side, VXX over here on the right, that's the ETN that we talked about here. And this is SPY, same time period, roughly 6 months from January 9th to today. I'm sorry, January 9th, 2021 to today. SPY gradually moving up, some hiccups there. The first beginning of those hiccups here, we start to see it a few days in, that's representing the spike of the VIX. But as SPY begins to recover, the VIX generally starts to turn down. This is not a chart we would look for a covered call, naked put, bull put credit spread, collar spread, anything that's neutral to bullish, even a calendar spread. You'd look for more of a bearish position, maybe bear call credit spreads or something along those lines, if you're expecting the market to continue this type of trend of melting up to new highs, having a little hiccup, get a little hiccup there, get a little bump there, a little hiccup here, little bump there in the volatility, but overall the trend has been downwards. So as the market is trending upwards, the VIX is going to continue to move down. Now that probably wasn't Anthony's sentiment. He probably already knew that. Anthony might be considering the idea of, is it a good approach? Because if the market turns bearish, then we're going to see the VIX increase. Well, there's a fair trade-off there. In other words, if the market is bearish, if it's gradually bearish and declining over the next 30 to 60 days, you'll see a spike in the volatility, but then it will pull back. Here is an example. This is September of 2020, September 10th or September 8th of 2020. There you go. To November, a 2-month time frame. Again, we're looking at the VIX directly versus SPY. SPY was moving up, and you can see the VIX was hanging around in the first 2 days. Suddenly, SPY dipped, and the VIX shot up. But then it sort of hung about, and for the next 20 to 30 days, it sort of declined down. It was a gradual decline after that initial bounce. And the VIX and the volatilities responded to that initial bounce, but over that same time frame, they continued a downward trend. If the downward trend is gradual, 30 days, 40 days, 50 days, it happens again over here towards the end of October. And we do start to see those spikes up when that happens, but it was mostly stagnant during the time the decline started. It was very gradual until the big movements here. And that's when we see those. And then, of course, as the market moved back up from that low, the VIX shot down percentage-wise just as much, if not more. Now, if the market becomes more volatile, as in it did from October, into basically beginning of November, before the end of November in that case, down 4 to 5% in 3 days, up 2% the next day, down 2% the next, up 4% the next. It's bouncing all over the place. The ETFs and the ETNs will spike up and spike down. Right? They're going to bounce around the strikes for the covered call and the collar position in a more volatile market. That pattern might give you a more neutral to bullish trend that you want for a covered call, but it's very quickly going to come back down. Even for a protected collar, where you have the out-of-the-money put in place for a low risk to the downside with still a positive return to the upside as well. So the VIX is more commonly used, and the volatility ETFs are more commonly used to hedge a portfolio for the unexpected, what you don't know is coming. Planning a trend for a neutral to bullish position on the VIX, VXX, UVXY, VIXY is a little bit more difficult, because even in gradual downturns where the market's going down 20 to 30 days, you get a spike that's neutral to bullish for your position, but then you start to see a decline because it's not a major volatile movement. It's just a gradual easing, perhaps a slight correction in the market. That's not increasing fear. That's just a correction. A correcting market or something that's declining because maybe it was overbought, and the volatilities won't go up in that price as well. So even in a gradual decline, and if you're expecting a correction coming up again soon, in that case, if you're expecting a longer-term correction, 30, 60 to 90 days, trying to play the VIX as a neutral to bullish strategy might not be the best idea, because on a long-term gradual decline, it'll do this. If you're expecting a volatile shift in the market, something that happens over a 5-day period or 6-day period, Very difficult to do, to track the unexpected, I know. But this is where we might consider buying calls on the VIX or buying shares of VXX or VIXY as a hedge to the larger portion of our portfolio. For example, if 10 to 15% of my portfolio is in credit spreads and another 5 or 10% is in diagonal calendar spreads, leveraged spread trades, which can lose 100% of their value if the market suddenly shifts over a 3-day period because of some unexpected event, the calls on the VIX will increase, helping me to hedge some of the loss I'm going to be taking on those bullish positions as the market turned down. That's the general way that we look to use the VIX, VIXY, and UVXY, not as a standard covered call approach because it's tricky to track. And it's tricky that even when the market is declining, you see here that your volatility ETFs are also declining. It's only in the sudden movements where you get the neutral to bullish spikes on the position. And now timing becomes extraordinarily essential as well.